In this video, we're going to walk through building a straight-line bond amortization table, as well as preparing journal entries to record the issuance of a bond at a discount, the semi-annual coupon payments, and the retirements of the bond at maturity. We're also going to calculate the market interest rate on these bonds. We're told that our bonds have a $600,000 face value, a $570,000 issue price, which of course means the bonds are issued at a $30,000 discount. The bonds have a 20-year term with a 10% stated interest rate. And again, the stated interest rate is the interest rate that determines the annual coupon payment, and that the coupon is paid on a semi-annual basis. These bonds will be issued at a discount if investors demand higher than a 10% interest rate on their investment or loan to this company. Again, the company has promised a 10% stated rate, but if you want to earn 11%, 12%, basically anything higher than 10%, these bonds would not be very attractive, and the company would have to lower their selling price or issue price in order to get you to purchase the bonds. We can go ahead and calculate the market interest rate on the bonds. We can do this using Excel's rate function or a financial calculator. We enter in the number for the number of periods for this bond, which in this case would be 40 periods. It's the 20-year term times 2, since it's a semi-annual coupon payment. The payment will equal the face value of $600,000 times the 10% stated interest rate divided by 2, since it's a semi-annual coupon. And of course, we would enter the present value as the issue price, how much the company is receiving. And of course, the future value would be the face value, how much the bonds will be worth at maturity. Notice the payment and the future value signs have the same sign, and it has to be opposite from that of the present value. That's because these are cash outflows from the company, while the present value, or the price the company receives, is a cash inflow. One thing that's important to note is that when we use the rate function or our financial calculator, we are solving for a 6-month interest rate, since we used 40 6-month periods in our calculation. To get the annual market rate, or the effective annual rate, we need to multiply that rate by 2, and we get 10.61%. Again, notice that this rate is higher than the bond stated rate, which is why the bonds sell at a discount. Investors demand a 10.6% rate of return, yet the bonds are only paying a 10% rate of return. The only way we can sell or issue these bonds is if we do so at a discounted or lower price. Our journal entry when we issue the bonds will involve a $600 or $600,000 credit to bonds payable. We always record bonds at their face value. We are receiving $570,000 in cash, so we'll need to record a discount of $30,000. Let's go ahead and take a look at our amortization table to amortize our discount on a straight line basis. Our unamortized discount on the bonds is the $30,000. Our book value at the time the bonds are issued is the par value minus the discount, or $570,000. We're going to make an interest payment or a coupon payment at time 1 of $30,000. That's going to be our semi-annual coupon payment. And again, make sure you calculate this with an Excel formula. This will be the same payment we make every 6 months for 40 periods over the life of the bond. Our unamortized discount will be our amortized discount will be the $30,000 discount spread over 40 periods. And again, 40 periods because it's a semi-annual coupon. Our interest expense then will be the $30,000 interest payment plus the $750 amortized discount. These 3 amounts you'll see are the amounts that will appear in our journal entry for our semi-annual coupon payments. After 1 period, the unamortized discount is the $30,000 discount from the prior period minus the $750 discount that we amortized in the current period. Our net book value of the bonds will increase from $570,000 to $570,750. Again, this is always the face value, in this case the $600,000, minus any unamortized discount. If we use Excel formulas in this row, we can copy this row all the way down our amortization table. I've broken it into two parts since I've hidden the years or periods 15 through 37. One thing we can note is that at maturity, the bond's carrying value equals its face value. We have fully amortized the discount. Let's go ahead and take a look at our annual journal, semi-annual coupon payments, the journal entries we make. Again, we're paying $30,000 in cash. That was the face value times the stated interest rate divided by 2 for a semi-annual coupon. The discount on our bonds payable will be credited $750,000 every period for 40 periods. And of course, 40 times 750 equals the total $30,000 discount. And our interest expense is the $30,000 cash payment plus the amortized discount on the bonds payable. At maturity, we will pay our investors $600,000 cash and remove the bond payable in the amount of $600,000 from our books.